It's the Trader Tip of the Week, and I'm Christopher Mullen from the technicaltraders.com. Now, if we were to take a look at the stock market, we can look at the SPY ETF. You can see we've had some pretty big bouts of selling. The market is currently down, as of this video, about 11% on the SP 500. But what I want to look at here is where money has been flowing. Over the last couple of months, we've seen money wanting to flow into the more defensive plays here. And if we were to take a look at SPYD. Now, this is the dividend paying stocks in the SP 500. So as you can see, it's only down 2.5% versus 11% on the SP 500, holding up in a much tighter pattern. Overall, it's a pretty strong pattern. In general, we've got an upward bias. We've got kind of a pennant formation or a consolidation pattern through here that if this rally to the upside here consolidates, there's potential for about a 4.5 to a 5% move, or at least to come back up to test these previous highs that we saw just a month or so ago. Overall, money is definitely moving into these defensive plays. We're also seeing money flow into commodities, into gold. Even bonds are holding up relatively well considering rates are going to be going up. So we're definitely seeing nervousness in the market. Now, I do want to point out one thing. If the stock market does collapse and we go into a big wave of panic selling, we see another big leg down, dividend stocks can actually sell down more than the stock market, than the SP 500. For example, take a look at what happened in 2020. And this is why when it comes to trading and investing, it comes down to position management, risk management. It is the most important part of all your trading, not so much the exact timing of your trades, but how you manage them, because you never really know what the market is going to do, and you've got to be prepared to protect your capital. Now, here's the SP 500, the SPY. You can see it dropped roughly 35% during the COVID crash. Now, that's a pretty big drop. If we take a look at SPYD, the dividend stocks, let's go back and take a look at that time frame. And if we take a look what happened during the high here down to these lows, you can see it is a much more dramatic sell-off, almost 50% drop. And the reason being, the large cap stocks are where most of the investment capital goes. They've got the volume, they've got the liquidity, and so and not to mention it's the dividend. It's where people want to go. So when the average investor gets to a state of panic and they start to sell everything they own, most of it is going to be in these large cap stocks, which is why we see the large caps and the high dividends fall the most, because the average investor is panicking out of what they think are the most strong and stable companies, but that creates a waterfall sell-off and it creates more downside potential to these, rock solid companies with high dividends. They can get hit very hard. So just be aware, it comes into managing risk and position. You've got to have profit targets. You've got to have trailing stops in place. And when they get hit, you got to take them. Sometimes we don't like hit when stops are tagged, but getting out with a small loss versus a nasty loss that can set you back years or decades investment wise, you don't really want to do that. So hopefully that's going to give you a helping hand. The SPYD definitely looking like it's primed and ready to move higher, and it's holding up the best out of all of them at this point. As long as we don't have an event that creates panic, mass selling, then I think these are going to do very well going forward. Anyways, that's it for now. Take care.